Hi, thank you for tuning in to yet another episode of our podcast. So, if you look at the beginning of May, it's been a very interesting developments that we're seeing across the globe. Some expected, some unexpected. If you look at what happened in India, in an unexpected development, the RBI held an off-cycle meeting and decided to hike the policy rate by 40 basis points to 4.4%. Street wasn't expecting this. They also hiked the cash reserve ratio by 50 basis points to 4.5%. All this leads to higher rates in the economy and higher rates of borrowing. So the rate hike marks the withdrawal of the pandemic stimulus, and it marks the shift in RBI focus from growth clearly towards inflation control and macroeconomic stability. Rates may be further hiked. We're expecting the rates to reach about 5.15% initially over next 2 to 3 meetings, and it will coincide with the same level prevailing before pandemic. And probably if inflation stays sticky, which we expect to, rates could further rise to 5.56% by mid next year. The timing of the rate hike may have come as a surprise, but conditions for monetary policy tightening have been building for long. If you clearly look at indices, be it wholesale or the consumer price indexes, they were all shouting that there has to be monetary tightening. And if you look at wholesale price indexes, have exceeded 10% levels for 12 months consecutively. Even if you look at consumer price index, it was above 7% or at 7% in March. And the RBI fears price pressure may remain elevated in April as well. Probably the next inflation reading may be worse on the consumer price indexes, and which may have compelled RBI to act hurriedly. So with crude oil prices remaining at above $100 a barrel, plus if you look at the context where European Union is set to consider phased ban of Russian crude oil imports and product imports, indications of further inflationary pressures could be there, and it may stay here for longer, and therefore warrant more RBI actions. So that's one of the bigger risks investors need to watch out for. Inflation still remaining high, compelling central banks to act. From a bond market perspective, as we expect RBI to hike further, investors in debt funds should brace for higher volatility. That usually comes with increase in interest rates. Since the rate cycle is still on, the hiking cycle is still on, it is best to stick to short end of the curve and probably be in short-term funds like liquid funds, which do not take much duration risk. The longer end will continue to see higher uncertainty going forward. Central banks across the globe, not only India, have underestimated the inflationary pressures and are now rushing to tighten monetary policies. The Federal Reserve also raised the Fed fund rates by 50 basis points. It's the biggest hike since 2000, and announced it would start shrinking its $9 trillion balance sheet next month. The Fed would likely pursue at least a couple of more 50 basis points hikes before they slow down their pace to 25 basis points per meeting. Given that the Fed chair ruled out a possibility of a 75 bips hike in future meetings, does not signal that inflation is peaking or flattening out. It does not make them dovish if they do a 50 instead of a 75. So overall, if you look at the global backdrop, there is still high uncertainty emanating from global inflation in commodities, especially food and energy, increase in interest rates, which will be part of what we will see going forward. There could be more outflows by foreign investors as interest rate increase, and there is move from equities to bonds and emerging markets to developed markets. There could be impact of inflation on corporate profitability as well. Plus, risk of any further COVID infection waves also remains. It is clear by now that inflation is no longer transitory, the way we have seen increases in the recent past as well. Higher interest rates will also compress stock valuations as discounting rates go up. So higher the valuation, meaning high PE of the stocks, higher will be the sensitivity to changes in interest rates. So one should avoid high valued stocks in this kind of market scenario. High leverage companies will also see pressure on earnings due to interest costs going up. So, because of these two factors, equity markets are expected to be much volatile going forward. A portfolio which is comprising of businesses with reasonable valuations and less leverage, meaning less debt on their books, will be best suited in this environment. What are the drivers of earnings growth, if you ask me, going forward? Is, for example, what we've seen is the third wave is virtually over, and we have seen restrictions getting lifted. Business environment has normalized with sharp increase in consumer discretionary spend on contact intensive industries like travel, for example. Corporate profitability remains high, which was driven by formalization of economy, demand revival, and better cost management at companies. Corporate profitability remains robust. What we were seeing, say, for example, in a period from 2015 to 2020, we didn't see much earnings growth happening, but now we are seeing uptick on at the ground level, and corporate profitability has improved. But going forward, because of high inflation, higher input cost, we may see some pressure due to rising input prices. What we have seen, one more trend is because of things like demonetization, GST, COVID, larger companies have become more larger, and that trend is likely to continue. One big driver of overall economic growth will be pick up in real estate activity. For example, home mortgage rates are at 20-year low, though it may increase going forward next year. In 1 year, you may see an uptick of 1 percentage points in home loan rates. But we have seen good pickup in residential because of the affordability factor increasing from income to EMI perspective, and that is not changing much even with the increase in interest rates. IT hiring also has led to increased consumption. So overall, these two are the biggest drivers that we are seeing unfolding for the economy. And because of these reasons, actual earnings may continue to surprise consensus. So how do you, invest given the scenario? And if you have an extended war, it could continue to disrupt supply chains and push commodity prices higher. Uh, India, because of self-sufficiency in food, has been a beneficiary and has prevented significant increase in food inflation. Though there are pockets like, for example, palm oil, which will also hit us. But overall, above cereal prices, wheat, rice, etc., will not impact us much. So rising commodity prices may dent near-term profitability. It may also impact consumer discretionary spend in the short run. Companies are expected to gradually pass on the price increases and get back to normalized margins. Only high quality companies will be able to do that given their leadership in their sectors. So if you look at our portfolios, they are positioned for an economic revival. We are kind of overweight in sectors like financials, materials, consumer discretionaries, and utilities. We have built a portfolio that will withstand interest rate volatility, whereas the companies that we have invested in have strong balance sheets, have cash on their books, and are less levered, and will likely benefit or remain stronger in this scenario that we may witness going forward. What are the risks to equity markets? Largely rising inflation, weak state of SME companies, which may impact consumer discretionary spend. That remains a clear risk and which we're watching for. Extended war, which may lead to impact on supply chains further, and non-availability of raw materials or increase in prices. And inflation, I think it's going to remain with us for at least a couple of quarters, and which will impact weaker companies will not be able to pass it on to consumers. So equities in the short term can be volatile, but these could be good pockets to add and build your portfolio allocations. Only invest with a very long-term horizon. India will continue to grow at 6.5%, and therefore investors can benefit from that growth, nominal growth of 11-12% that India will witness. So Higher interest rates can impact both valuations and profitability. A portfolio comprising of businesses with reasonable valuations and less leverage will be the best bet in this environment that we will envisage or will witness over next 6 to 12 months. So with that, I hope that we've added value, and wish you good luck, and take care. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.